Hey, everybody, I want to talk about keeping sight of the big picture. This is a conversation I have with clients all the time. So it's really important that we take a step back. It's very easy for us to be emotionally involved in our own finances for obvious reasons, especially if you rely on them in retirement. So first thing I want you to know is whether you have enough or not, right? I mean, that should help you at least understand how much your resources will provide compared to what your needs are. So you start with adding up your total savings, right? You got to know how much money you have. So start by adding all that up. The next thing is divide by years in retirement. How many more years do you think you have left? Okay, some people want to reach 100. Some people think there's no way they'll even get to 90. But always go, no, maybe 5 years longer than you think you're going to live, because weirdly, the statistics show very convincingly that we live longer than we think we will. There was a 30-plus year study asking people how long they thought they were going to live, and then they tracked it. So push out 5 years. If you don't think you're going to live to 90, maybe you should use 90, maybe 95. I usually use 100. I know a lot of people will argue with me on that, but that's because I don't want you to run out of money, okay? So then you take that total savings and you divide it by how many years you're going to be in retirement, right? How many years you have left. So how much savings do you have today and how long you're going to need it for? So in my example here, it's $1 million divided by 35. Okay, so somebody that has $1 million in savings and 35 years left in retirement, if we throw all this money into $1 bills all over the floor of the house, you can wake up every morning and do snow angels in $1 bills. That'd be fun, right? Okay, but the cool thing about this is it tells us how much we can pull from that pile of money every single year. You take the million, you divide it by 35. In my example, it's $28,000. $28,000 I can pull every single year for 35 years without running out of money until 100 in my example, right? 35 years of spending $28,000 at zero growth. That's the number we want to come up with. Then I want you to add that to your total income, your guaranteed income, right? Your Social Security pensions, if you have any annuities that are paying guaranteed income, add those together. In my example, it's $68,000. So what we can withdraw from our savings at zero growth, what we have in guaranteed income, and then we need to match that up with what our budget looks like. How much do we need for the I have to pays, and how much do we typically want for our I want to pays? Okay, there's a reason that we do this for with zero growth. Okay, and some of you may already realize why we do this at zero growth. It's because I want you to be able to invest to keep up with inflation. Okay, if your math works out on this page, then all you have to do is don't lose your money and do the best you can to keep up with inflation. It's really that simple. So this is the first step in going through and keeping an eye on the big picture that will help you shelter those storms when things are going up and down and they're uncertain financially. We get that inflation number and that starts scaring us. We see our bills getting bigger. This is the first step of that. Then take a step back after doing that and saying, well, in the grand scheme of things, what should our portfolio look like? Okay. The reality is this chart here is meant to be in extreme generalities because the statisticians that created each of these lines, the vertical is how much of your money should be in the stock market as a percentage. The red line is the aggressive model. You look at that and 100% of your money should be in the stock market until you start reaching the point where you're going to start needing your money. And then you start pulling it back the more you need this money. So you can think about this in a lot of different ways. You can say, okay, if I'm 10 years from retirement, I don't really need my money yet. But once I'm 5 years, I got to start pulling it back. But you can also look at this as a withdrawal rate, okay? The higher your dependence on this portfolio for income, the less it should be left to chance, right? If you need this money, you don't want the big crash in the stock market. Like 2008 is a really good example of this. People that thought they were going to retire in 2008 or 9 all ended up working much longer than they thought they were because they were so confident in their stock portfolio they never pulled back risk. Well, we're in this all over again. This pandemic crash was so fast. They're like, 40% down, no big deal. It'll be 80% up in the next couple of months. We can recover so quickly. Well, 2008, it took 4 to 6 years for most people's portfolios to fully recover. So we've got to be careful. Just because we've seen it this way in our near history doesn't mean that it's always going to be that way. 9/11, we had the market go down 3 years, double digits in a row. It's not easy for portfolios to endure that when you're in retirement pulling money out of there. The next thing you have to know is the larger your withdrawal rate, the greater the effect of volatility. Okay? For instance, a 4% withdrawal rate, volatility is terrible for your portfolio. And that's why when you see the red side of this, those are the retirement years. If you are the typical person that needs their money and is pulling anywhere 3-4% or more out of their portfolio, no more than 40% of your money should be in the stock market, according to every statistician that has studied the markets and understands this and can defend this in the court of law. Okay, so the rule of thumb is that 60% safe, 40% if you need. Remember, need is different than want. If you need your money to fund your retirement, we should be starting with that 60% safe, 40% stock market. And then we need to look at your situation and adjust for what makes you different than everyone else, right? Need and type of withdrawals. Are we just pulling because every once in a while we want to take a trip? And if the market goes way down, we don't really have to take a trip. We may not want to travel. Amount of savings, okay? If you're Warren Buffett and you're pulling 1%, less than 1% out of your portfolio, you can handle all the fluctuations in the world. It's not going to bother you. Your personal risk assessment. How do you feel about risk? And then leaving it to heirs versus spending it. These are all things that are going to change how you're going to handle the typical situation. Next part I want you to understand the difference of is losses versus turbulence. Okay? Losses. We have to understand what losses are because losses in retirement are bad. And what do I mean by losses? Well, that's a chart of Enron. Any investment that goes to zero is considered a loss. I think we can all agree with that. You buy 10 stocks and 2 of the stocks go to zero and 2 of the stocks shoot to the moon. That's called diversification. But we should be able to avoid that in retirement. As you head to retirement, investing in individual stocks exposes you to that chance of actual losses. Private investing. Okay, look, I see too many people investing privately that should not be. Okay? The money you invest in private investments should be the same type of money you would go to a casino with, the same type of money that you've allocated to day trade away in the stock market. If you can handle the risk, I'm all for it. But understand, private investments are sold to you based on what the salesman understands of the investment, not because it's audited or has any form of a track record that is legitimate in any way, shape, or form. Okay? Please be careful in the private investing world. The answer is always yes, it has a chance to go to zero. So what is your upside? Is your upside 10%? Are they telling you you should expect 10% return? Well, think about that. 10% return versus zero, 100% loss. I don't think that risk parameter works for most people in retirement. Doesn't make a huge amount of sense. So if the answer is always every private investment has the chance to go to zero, you need to be able to triple, quadruple, multiply that value times X, significant X, for zero, for 100% loss to be that risk parameter. So be very careful about private investing, especially as you head into retirement. Selling at a loss to spend money. I don't like this. This is what every portfolio for every retiree should avoid. You should never look at your portfolio and sell an investment that's down to spend that money. You want to sell it and move it to another investment, go for it. The other one is emotional selling without reinvesting. The pandemic was a great example. A lot of people, very easy, hit a button, boom, sold, gone. You probably paid a bunch of taxes, but the reality is you felt good about selling because you knew the pandemic was coming, you knew the pandemic crash was coming, but then the problem was you didn't get it reinvested, and that market rocketed, and nobody believed that was the bottom. They thought it was coming right back down, and you didn't get invested until after the rocket launch. So you locked in a bit of a loss because most people didn't sell until it began sliding, and then you weren't there for the rocket launch afterwards. Losses, we can avoid these, okay? It's very easy to avoid these things in retirement. So the understanding of losses versus turbulence. Turbulence is fine. We built our wealth in a turbulent stock market, okay? But mutual funds and ETFs, boy, the chance of those going to zero is a heck of a lot less than buying individual stocks. If you own the major mutual funds and ETFs, if you own the S&P 500 versus picking 500 stocks, you're not going to go to zero. So diversification is the way we fix that. The ability to use other savings while waiting for a rebound makes the ups and downs of the stock market just turbulence. If you have investments that you can pull from that did not lose, that's how you're going to handle this and make sure turbulence doesn't really affect you, and helps you sleep at night knowing that only part of your portfolio is going through whatever's happening in our stock market. So adjusting, investing instead of reacting is also just turbulence. You can sell an investment at a loss as long as you're reinvesting it for a better future. Okay? Don't let what's called sunk cost affect your decisions going forward. You can't sit here and wait for a bad position to recover. What you can do is sell that bad position and invest it for a better future. There is nothing wrong with that. That's not locking in losses. That's trying to improve the future. All right, so what I want you to step back and remember about this big picture. Deposit into volatility to build wealth. Withdraw from stability to maintain it. If you had a 40%, or I'm sorry, if you had 40% of your money in the stock market and it went down 40%, remember that's only a 16% downward movement if the rest of your portfolio didn't do anything. Okay, so when we talk about different assessments of risk, if you only had 40% of your money in the stock market and didn't go through wild ups and downs, well, the rest of your portfolio should be stable. And if it didn't grow at all, which it should still grow if you're in the safe, stable investments, then you're going to have even less than a 16% downturn in your portfolio. So the big, huge, downfalls when the pandemic hit, we had about 40% loss in a month. 9/11, it was about 40% over 3 years. Then you looked at the 2008, it was about 40% as well. So our big downturns were about 40%. So that helps things stay into perspective in that big picture. Utilize principal protected safe investments with access to withdrawals. That's the hard part in this world. Look at safe investing strategies without your biases, because there's so many different choices out there, and there are some that are much more appropriate for others. So safe investments that you can withdraw from. In history, that's been like CDs that you laddered and make sure that you had one mature every year. Not, a little cumbersome, not very friendly these days. You got things like fixed annuities, the top safe investment for 2023, billions. And when I say billions, we're talking over $100 billion of individual investor money went into MIGAs, multi-year guarantee annuities. It's a CD with an insurance company that you're allowed to withdraw money from if you need it. That's the type of safe investment you need. So the rest of your portfolio can go up and down, and if you need money, you can pull from there instead. You got to find a way to invest safely that allows you those withdrawals. We used to use bond funds, but the reality is that's a risk that retirees can't take, right? Bonds and bond funds go down in value as interest rates rise. And so every time we see fits of inflation, you're going to lose money in your bond portfolio. Your safe portfolio should not be losing when we are experiencing inflation. You can't do that anymore. If we get back to 10, 15, 20% interest rates, you want to get back into bonds at that point. I'm all for it. I'm going to root bonds on. But the reality is we're floundering around very low interest rates. You might feel like they're higher, but look at the grand scheme of things. We still have very low interest rates in the United States. And bonds will get hurt every time we raise interest rates. So be careful about that. All right, I hope that helps. I want you to see the big picture. It helps you take a step back, assess your situation, understand that you can handle those fluctuations in the stock market, so it relieves some of that anxiety. If I can help in any way, yourinvestmentcounselor.com. You can schedule appointments directly with me. I've got a free 30-minute meet and greet on there. This is what I love doing. I love talking through situations, building financial plans for people, especially as they're heading to retirement, and then handling those first few years to be there as a coach by your side. Full classes. I do full form, hour and a half long classes. Every month it's a different topic. You can find that schedule on fpfeaz.org, fpfeaz.org, and then give us a call if we can help in any way. Thanks again, everybody, and see you next week.